There are two problems in investing for the long term. The number of companies that continue to do well for a very long time are very few, and our ability to see the very long is also limited. What is the alternative to long-term investing? Before we delve into it, some interesting insights. Steve Jobs became a big shareholder of Disney when it acquired Pixar. Surprisingly, he didn't trade those Disney shares for Apple shares because he didn't anticipate how successful Apple would become. Apple went on to multiply wealth at least 80 times in that period, and Steve Jobs held on to the Disney shares, which hardly went up 4 times. This shows that even the person in charge, Steve Jobs, couldn't predict the long-term future of his own company. How can investors then? Aditya Puri, who founded HDFC Bank and whose profits compounded at 20% for years, mentioned in an interview to the effect that when he first started the bank, he had doubts about whether he made the right choice of moving from Citibank to set up this bank. Even the company promoters sometimes aren't sure about the long-term success of their business. As a regular investor, predicting a company's future can be very challenging. In the book Built to Last, James Collin outlined how to evaluate company management by studying successful habits of visionary companies. He came up with a list that made these companies successful. These companies had outperformed the market by 15 times. Many of these once successful companies are now either irrelevant or close to bankruptcy. Please like this video so it gets across to a wider audience. Another book was written, Good to Great. Elite companies were identified that went on from being good to great, and many of these companies today are irrelevant. The list of most admired companies, every 10 years, we see great companies disappear from the list and are replaced by new great companies, which again disappear from the list. Companies that achieve long-term success often ends up surprising their own management. Predicting such success with high level of certainty beforehand is typically challenging. Samir Arora of Helios Capital suggests investing cannot be long-term. It cannot be a fill it, shot it, forget it dream. Since predicting long-term is difficult, he suggests focusing on the short horizon. Forecasting for 1 to 3 years is easier, and regularly revisiting these investment theses over shorter time frames. His company follows an investment philosophy, elimination investing. In a classroom, it's often easier to identify the students who are misbehaving because bad behavior comes in more clearly defined ways. Goodness, on the other hand, can have many interpretations and is more complex to pinpoint. Similarly, dropping weak stocks based on fundamental research boosts portfolios' performance. This research reveals that many companies consistently outperform the NSE 500 index. Close to 50% of them surpass the index's performance. For instance, in 2022, over 213 of the 500 companies did better than the index, which is 40% of the companies outperforming the index. In 2021, the number was even higher, with 279 companies, or 55% of them, outperforming the index. In 2020, 231 companies, or 45%, did better than the index. Additionally, a notable finding is that nearly 33% of the NSE 500 companies perform exceptionally well. In 2022, while the index yielded a 4.4% return, the top 33% or 150 companies ranked in terms of performance achieved returns exceeding 16%. Significantly surpassing the index performance. This trend holds across all years, with the top 1/3 of the companies consistently outperforming the index. Despite the index delivering a cumulative 1000% return, the top 33% achieved more than 10 times better returns. On a similar note, the last 1/3 or 350th to 500 company ranked by returns underperformed the index terribly. Elimination investment aims to avoid the stocks, very similar to identifying the mischievous boys in the class, which is much easier than identifying the good ones. Nassim Nicholas said acting by removing is more powerful and less error prone than acting by addition. The fund house employs a screener to identify problematic companies. Limited growth potential in an industry, example, the print media industry, due to the decline in print circulation and advertising revenue. Industries like the airline face unfavorable dynamics, including price controls and vulnerability to oil prices. Certain businesses are more susceptible to disruption, such as the public telephone, travel agencies, cable TV. A few promoters raise suspicion. Forensic accounting is employed to detect problematic companies, while some stocks are excessively expensive, offering limited room for returns. Please consider subscribing and sharing this with your friends.